Welcome to the Value Investor TV podcast. This is a podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner Hari. This is episode 28, Price to Earnings in Detail. Now we talked about, before we do that actually, let's do a quick review of what we did. So in the last two episodes we talked about the checklist. Again, if you haven't listened to that, please go ahead and do. And if you want our checklist, email us at info@valueinvestor.org, O-R-G, or tweet us or follow us on Instagram, whatever channel, reach us, and we'll provide the checklist. Again, so that's what we covered in the last episode. In this episode and another episode moving forward, we're going to talk about the valuation metrics in a little bit more detail. We covered the kind of summary of valuation metrics in previous episode. We talked about valuation ratio, we talked about financial ratio, we talked about operational ratios. And in this episode we're going to dig a little bit deeper into a few valuation ratios, actual ratios, in a little bit more detail. In this episode we're going to talk about the price to earnings, PE, as a lot of people call it. And this is one of the valuation ratios that is widely used. Very, very widely used. And people talk about this as kind of the first entry point into the valuation measurements, I think. A lot of people talk about PE, and then they'll branch off into different ways to dissect the valuation ratios. But again, this is kind of the entry point into the valuation discussion. So before anything else, let's dive into the definition of it. What is price to earnings? Hari, what is price to earnings?
So there's a couple ways you can say that. It's price, which is the current share price, divided by earnings per share. So price per share divided by earnings per share gives you price to earnings. The other way to do it is the total market cap of the company divided by the earnings of the net income of the company. Mm-hmm. And those two numbers give you the same ratio. And what that number tells you is how expensive or cheap, it is, right? And that is something that you should be using from an annual basis. So it's not a quarterly ratio. It is you would have to have 4 quarters or 1 full year of reporting. So typically you want to do that on calendar years, so the company has a fiscal year 2016, 2017, 2018. You can also do it on a trailing 12-month basis, which is the last 4 quarters. If we're in Q3, then you're actually using Q4 of last year and then Q1, 2, and 3 of this year to measure it. What really? Oh, go ahead.
Or you can annualize a quarter also.
Yes.
So you just take the net income and times 4.
Yeah.
And people do that also.
So So you want to do that in businesses though that have very stable quarter to quarter earnings.
No seasonal fluctuations.
Yeah, seasonal fluctuations are a big deal, so you should be careful of that.
Yeah.
So anyway, the thing is about the PE ratio is that it's often used, and it's often used poorly, right? Because what happens is that people look at the number, they say, oh, it's less than 10, or it's less than 8, and then it's cheap, or it's greater than 20, or it's greater than 30. Well, so none of that takes into account all of the other factors that come into what's going on with the company, right? Company with a PE of 7 who has a declining business, that may be expensive, right? Because their next year's earnings may not even match, the current year's earnings, right? And then you have a business that has a PE of 20. Well, and you may say, well, 20 seems high when, the average, is 15 for the stock market. But at 20, the company's earnings are growing at 40%, 40% a year. So a PE of 20 may actually be a reasonable number in that scenario. Now, it's tough to just make those, kind of generalizations. Mm-hmm. You also have to remember that sometimes companies take non-cash expenses, and that can change the way that the nature of the business. So when a non-cash expense is accounted for. You see a lot of these stock databases where people screen for price to earnings ratios below a certain number. Well, the company actually has a PE of 7 when you account for this non-cash expense that they took on the earnings. That's a one-time thing and shouldn't be really used, in the measurement. And so then they miss those, those companies. Mm-hmm. So you have to be really careful about using this, because first what you should do is adjust the earnings for, one-time changes. If they are discontinuing businesses,
yearly changes.
Yeah. Those kind of things need to be accounted for and removed. Mm-hmm. So that helps you get a real PE, right? And then that number is more accurate than some of the other ways of measuring the business, right?
Yeah. I think what I like to do personally, maybe you could chime into this also. What I like to do is I like to take earnings for the last 3 years or 4 years and then average them out. Just take a mean of that, and then use that as earnings and divide it by the price, or price divided by that.
Yeah. So in the event that a company isn't growing at a crazy rate, that is a very effective way, because it tells you more accurately what the earnings are, right? Also, if they're declining quickly, you kind of want to make sure. But if this is more of a seasonal problem, or they had a 1 year that was just bad for whatever reason, mm-hmm. that may affect how you think about it, right? Mm-hmm. So that number is kind of helpful, in identifying it when you use the 3-year average, because then you can look at a 3-year average from 5 years ago, 10 years ago, and a 3-year average now, and then kind of have a understanding of their growth rate,
right?
Like of their stability of their earnings and that kind of thing,
right? And that kind of ties into, this is not something that directly pertains to price to earnings, but PEG is another kind of a derivative of this that shines light into some of that aspect of it. PEG, popularized by what's his name? Sorry, I forgot.
Peter Lynch.
Peter Lynch. Yeah, exactly.
So there's a couple things that I also want to introduce related to the PE, which is something that people often do, and Peter Lynch actually talked about this, is looking at the average PE for a company over a longer period of time, let's say 5 years, and then seeing what their current PE is relative to that. And so what that is kind of telling you is it's a relative valuation, which is also can be very dangerous, right? If but let's say that the average for the last 4 or 5 years has been 15, and now they're trading at 7. That can kind of give you an idea of, relative to its own place. The market had valued it at 15 times earnings, and at 7 times earnings, it's cheap, right? Now, where you want to be careful about that is, if the market had valued it at 40 times earnings and now it's at 25 times earnings, you say, oh, it sounds cheap.
Yeah.
Well, but that may be because the business is slowing. Mm-hmm. Their growth rate is slowing down, and so they're getting a cheaper, valuation.
Yeah.
So just be mindful of this, is that I like Peter Lynch's relative valuation measurement, but that's not the be-all, end-all.
Sure. And
I don't want to use that as a final decision maker.
Yeah.
Right? It's just another factor in using, valuation.
Yeah. Yeah, and also PEs, depending on the time, PEs, some industries are more richly valued than the others, for example, right? Yeah. Like right now, technology stocks are really hot, or has been for the past couple of years. And let's say, I don't know, railroad, or I don't know, a consumer product like
cars.
Car is a good example right now. And it's not, or insurance companies, they're not in favor right now. Market doesn't think that they're as valuable as technology companies. So depending on the time, depending on the people's psyche, the PEs for that industry will change over time.
Yeah, so the way to also, think about that is typically, and this is not always the case, but typically businesses that have high capital expenditures have lower PEs. The industry does, right? So railroads has a very expensive reinvestment.
Can you repeat that for our listeners again?
Yeah. So companies that or industries that have high capital expenses, so capital that needs to be reinvested to maintain the business, they typically have low price to earnings ratios. So you think about cars, where you have to repair and build new factories to build new cars. Railroads, where you have to replace trains, and you have to replace track, and you have to do maintenance and all of this stuff. As opposed to a tech business where they have PEs in the 5 to 7 range, and then you look at a tech business and they're trading at 40 times earnings, and that's because they have it doesn't cost much to extra to support more revenue.
Yep.
So and that usually means that higher quality businesses, that is measured by return on equity. So companies with very high return on equity of like 30%, 40%, typically also have higher price to earnings ratios.
Yeah.
So those are usually higher quality businesses, right? So what I would say is that PE is a good measure of how cheap a business is in the certain circumstances.
Yeah.
But you shouldn't use it as the final authority on on anything.
Yeah. So PE, interesting ratio that a lot of people use, like I said earlier, but there are a lot of caveats with it, and we touched on some of that in this episode. Anything else you want to add here before we close off? Ari, price to earnings.
Yeah, I mean, I think when we live in a society where people try to simplify things to the point of absurdity, right? And that is evident in the price to earnings ratio, right? So I think if you use the price to earnings appropriately, making sure that these are multi-year earnings, is it stable? And we've done this in our checklist. We've walked through all of these things to identify how stable the company is, and all that. Then PE is an acceptable way to do stuff. But once you start looking at the PE first and then only using that as a investment decision, first of all, let's just put it out there. If you buy a basket of blindly pick just low PE stocks, you actually have a much higher rate of return. So I think of the top decile of low PE stocks beats the market by 5-6%. So you can get a 14-15% return just by buying low PE stocks indiscriminately. You buy if there are 500 or 1,000 of them, you buy all of those. That is not strictly value investing, right? I wouldn't call that value investing. I would say that's
like indexing.
It's almost at an index at that point.
Yeah.
But that doesn't necessarily mean it's bad, right? I think Joel Greenblatt actually has an index fund that weights the S&P 500 by PE or by valuation metrics. I shouldn't say PE. So it gets about a 2 or 3% higher return, maybe even higher than that, maybe 4 or 5%. And so this is a very valid strategy for just picking low PE stocks. And but I think I think by filtering out some of the ones that are fake low PE stocks, you can actually do
a lot better,
even better.
Yeah.
So
yeah, exactly. Again, that strategy only works if you buy a whole basket of them.
Yeah.
Yeah. If you buy like a few of them and expect them to just pop,
right?
Most likely, if you don't look at the underlying business and just buy a whole bunch, a few stocks with low PE, that's not going to work.
Yeah.
Okay. A slight commentary on the society there, Ari, about the simplification, but I think it's an apt one, and I think it's certainly an apt one for financial industry.
Yep.
Okay. Great. That's it for price to earnings. We will talk about price to free cash flow in the next episode in kind of a similar fashion. But for episode 28, price to earnings, that is it for us. We will see you guys on episode 29. Thank you.
Thanks.